Hey, this is Dylan Fry, the real estate guy, here to be your guy for any real estate needs in the Kansas City area. I'm here to help you buy homes, sell homes in the Northland. I'm here to make sure that if you are doing that, you're doing it in advantageous strategies. We want to implement strategies. So today I brought in a finance guru. He's going to talk a little bit about infinite banking. He's been on our podcast before and we talked a lot about different tax strategies and everything there. Today we are going to be talking about infinite banking. If you don't know what infinite banking is, then I encourage you to do some research, look it up, find out who you can be listening to. I encourage you to go out and get this guy's book because it's going to be able to help you out and help you make better decisions with your money. I've got Andrew Keene here with Blackstone Wealth Protectors, and he is a proponent of saying the banker always wins. So we are going to talk about his infinite banking book that he's got coming out. Before we get into that, today, if this is your first time on the channel, make sure that you hit that subscribe button and then also hit that little bell so you'll get notifications of future interviews we do with people so that if you're living in the Kansas City area or you're looking to buy in the Kansas City area, you have people around here that are like-minded that you'll get to know and trust and that'll be able to help you with anything you need. So today I've got Andrew on here. I'm going to do a brief introduction because you've been on here last time, but do a little bit of a brief introduction and why you came back to talk about infinite banking.
Oh, well, thanks for having me back. I love teaching about finances. So there's a lot of myths, a lot of lies out there. And people just aren't prepared as financially as they could be and should be.
Yeah, I agree. I would agree with that.
So I want to help people make better financial decisions. And, you know, if we don't have the whole picture, we can't make good financial decisions.
Which has led you to, because you want to illustrate that out to people, you've been writing. I know you've written now, what is this, you're working on your third book, right?
So I'm working on my second book, Profit Like a Bank, Function Like a Bank, or Function Like a Bank, Profit Like a Bank. And then I've got another one that I've been working on as well, but I probably won't get that out till late this year. I think I'm going to call it Why Traditional Financial Planning Makes You Poor.
Okay. That's an interesting statement, which I will definitely be bringing you back in to talk a little bit more about that one. But I want to focus on the, what was it? You said, act like a bank, profit like a bank.
Function like a bank.
Function like a bank, profit like a bank. So I want to talk about that. Let's dive into it. What do you mean when you say that? What are you talking about?
So when you look at no matter what's going on in the economy, the market, et cetera, you know, the banks always profit. Good banks always profit.
Correct.
And we always need to get capital from somewhere. And so we've been taught to get capital from the banks. So what this book is going to teach you is how to become or create your own family banking system. And then essentially you're going to take that money that you've been given to the banks, credit cards, and other lenders, and you're going to put that back into your own economy, put that into your family banking system. What it does is without changing how you're spending money or anything like that, you're actually going to put hundreds of thousands of dollars or even millions of dollars back into your own economy. And all you're doing is you're shifting your cash flow. So you're making one minor adjustment from your cash flow. And typically we get paid, it goes into the bank, and then from there, we never see that dollar again. We lose current value and all future value of all that money. Whereas all we do is use a life insurance policy as a holding tank for capital, and every dollar that you put into that policy, it starts creating value for you for the rest of your life.
So talk to me a little bit more about that, because it's infinite banking has always been something that I've been intrigued about. I've sold a lot of life insurance policies, and we built systems that did similar things, but never to the level that I think you're discussing, which is putting a lot of your family's income into these life insurance policies, which essentially, so how does that work? What if I want to touch the money? What if I need to use it?
So I don't really like comparing life insurance to retirement plans, but that always gets brought up. We've been taught to put money into 401ks, IRAs, and so that locks up our money.
Correct.
But who's using that money? Wall Street gets to use that money throughout your lifetime, and you're just kind of left over with whatever's left.
And you're taxed on it.
Yeah. And with the life insurance, the way I approach it is using it as a holding place for your capital. So instead of putting money inside of a bank, putting it inside of a life insurance policy. That's how I approach the idea.
Okay. So let's say I get a policy and I want to say, hey, I want to learn more about this. I want to work with you. I've got X number of dollars. How much is normally the minimum that I need to really make this beneficial?
It all depends on the age, health of the client. If we're looking at young 20, you can start $200, $300 a month. And by the time you're 30, it's going to look pretty decent. I've got retirees. They put a lot of money into these. Generally, if you're in your late 30s to mid to late 40s, I'm going to say minimum is probably going to be 10 to 15,000 a year. But the way we design these policies is, let's say your premium is 10 grand a year. You have access to that from day one. I should say day 30. Most of the companies make you wait 30 days.
Okay.
You'll have access to anywhere from $6,500 to $8,000 from day one.
Okay. So, and just so our listeners are out there, so that they can really understand like what that money is doing. That money, so when you say I have access to it, am I essentially like just taking that cash out? Like how do I go about getting that access if I want to use that access?
So it's as simple as filling out your name, how much money you want, sending it back into the life insurance company, and then they'll either send you a check or put it in your account. And they say anywhere from 3 to 5 days. I usually have mine in 24 to 48 hours.
Okay. And what happens to this policy if I take the money out?
So there's two ways you can do it: withdraw or borrow. We don't teach to just withdraw your money. The way we approach it is you're going to borrow against your policy, so you're leveraging your policy. And this is what the wealthy do. They leverage their life insurance. They'll leverage stocks.
Correct.
And essentially, it's a banking system. It provides you a line of credit. And so what happens is your money stays inside the policy and it continues to grow.
Well, and I think it's huge because now if somebody's 20 years old and they're watching this, I encourage them, go start putting a little bit of money into something like $200, $300, $400 here, whatever it is. If you're still living at home and you're not paying any rent, go put your rent payment there, because guess what? Now they can come and get their down payment from you. Say they've saved up $20,000 in this policy, they want to go buy a house, they can come and take out that loan, and talk a little bit about that. But if I'm correct, that money is still technically in the policy gaining interest, and you're just paying it as you pay it back. You pay interest on the money that you borrow.
Correct. So your money's got to go somewhere.
Correct.
If you put it into the bank, the bank's putting it into life insurance already. It's called BOLI, bank-owned life insurance. And so they're making the rewards on it. So what happens is you put money into the bank, they're putting it into life insurance. You need a loan. Well, they're taking that money out of the life insurance policy and they're loaning you money. So they're essentially loaning your money at a higher rate. So their money is staying inside the policy, continuing to grow, and they're lending you money. So now they're making money in two places at one time. So banks have been doing this for 100, 150 years.
Yeah, and where you can just come out and...
So cut out the middleman.
Yeah, do it yourself. And then if you build something in here, and if you build something and you start it young enough, or if you're later to it and you're starting it now, build something that you can it's how you create generational wealth. And that's one thing that I always tried to do when I had my agency and I was selling life insurance policies. It was like, yeah, we can access this money, but you're not touching the money anyways, because a lot of the stuff I did, they weren't planning on using the money. But even if you're using that to, hey, I'm going to end up buying a house or whatever, you can get the piece that isn't talked about enough is that death benefit.
Yep.
Where when something happens to you, then that death benefit goes to the next person in line, tax free.
Mm-hmm.
And I think that's huge. That's how you create generational wealth.
Yep.
Now, talk a little bit about that. So, how do you structure these policies to make sure that they are continuing to grow, as opposed to I'm going to put these policies in there and then they become underfunded? I know that was a big thing back in the 90s, early 2000s. They sold a lot of these older policies.
ULs.
Yeah, universal lives that 2008 hit and then 2012 hit and they continued to drop. And then those policies, essentially, a lot of people were pissed off because they thought they were going to have $1 million.
So ULs, IULs, whole life, they're all permanent policies, but they work differently. So whole life essentially it's the same cost today, tomorrow, until the day you die. ULs, so they're universal life, and essentially they were built in a time period when interest rates were 12, 13%.
Correct.
So with the universal life policy and the IUL, they're essentially term policies built on a whole life chassis, which basically means they're term insurance. So when you're younger, they're a lot cheaper.
Correct.
Whereas whole life, they're going to be more expensive coming out of the gate because they basically spread the cost of the insurance throughout your lifetime.
Correct.
But what happened with the ULs is they were growing, fantastic growth. And then when interest rates dropped, they quit growing, but the cost of insurance kept going up.
Correct.
So with the low interest, it just killed them.
Yeah, and you're locked in at that. I mean, and that's the thing that a lot of people didn't understand is back then they didn't expect these policies to back when interest rates were 10, 12%, nobody expected them to get to 3.
No.
And that's one conversation that I have a lot with people now is back when I was selling those policies, when they were operating at 2.5%, 3%, I think like they were illustrating 4% back then. I was like, if interest rates stay this low or they go any lower than this, we're bottoming out as an economy.
Yeah. Over the last 5, 7, 8 years, the growth is good. It's not fantastic like it was back in the 80s. I mean, these policies were getting 12, 13% returns tax-free.
Yeah, which is crazy. It's crazy how much money was made during that period. And now I feel like a lot of people are, I feel like this has been one huge topic that a lot of people are talking about is the infinite banking. Mm-hmm. And I think it's something that people definitely have to grab onto and need to be cognizant of because it can really help them further themselves financially. And gives the stability of like, hey, I can go, if I want to do something, I can go do it. I used to encourage parents to buy policies on their kids because you can build it through there and then they can have an investment product as well.
So we've always heard that compounding interest is eighth wonder of the world. And they talk about the stock market being compounding, but the reality is the market does not compound. Every time the market starts to drop, your compounding interest starts all over. Not only that, stock market, you got fees, you got taxes. So the rule of 72 gets really thrown out the window when you sit down and do the math about it and you throw in the losses, the taxes, and the fees. They say your money doubles every so often. Well, that's just not the case. But with the life insurance, because the fees are already built in to the cost of everything,
correct,
and because it's tax-free, that is the only financial vehicle other than a savings account that gives you true compounding interest, and we know what savings accounts are doing. But on that side of things, the government punishes you for keeping money inside of a bank account because any interest you earn, you've got to pay taxes on.
Correct, which is not much, but it's still ridiculous. You are constantly have these hands coming out and grabbing different pieces of your money, and the things you're talking about is do it yourself. Like, go and have this person that actually helps you, and is helping you set up, again, generational wealth and a legacy. That's one of the big things. So when you're talking about this stuff with people, are you focusing on legacy? Like, what is the normal client that comes into you? Is that their concern, or are they just thinking, hey, this is another vehicle that I can use?
It depends on the client. I myself, I have a couple policies. One is built heavy cash value up front for me to use as a bank. One of them is built more for retirement plan, and one of them is more for a legacy plan. A lot of my clients are real estate investors, so we're looking at cash heavy up front. We'll even go as cash heavy as 85% up front.
Okay. So that way they can use it to structure their next deal.
Correct.
Pay it back to you, go back, do the loan, pay it back, essentially.
Now, the great part about that is the cash up front. The downfall is you're not going to be able to put as much money in the long run, and then your growth isn't as good as in the long run.
Correct.
Now, the hope is, after 5-7 years or whatever, you just buy a new policy, which is normally what people do.
Okay. So why would I want to buy a new policy?
Because you got cash coming in. You can either put that money in the bank or put it into somewhere that's going to provide benefits. So a bank's going to provide you with no benefits, really.
Okay, so you're saying here, and because I want to dumb it down a little bit for not because the viewers are dumb, but because the thing is, people watching this video, they're intrigued by it, because I'm intrigued by it. But they don't understand where to step, because it's like you're trying to learn to walk, and like I feel like I'm still an infant, like I'm trying to figure out how to crawl.
So we'll step it back. So when I talk about a banking system, I'm talking about a holding place for your capital.
Okay.
So have you ever thought about what a bank actually is?
What do you mean?
So when you go look up the definition of a bank, what it is an institution or a person that you give money to and they lend it out to make a profit.
Fair enough.
So that's what we do. We put it into a bank, they lend out our money, and they go make a profit off of it. Yeah. So instead of putting it inside of a bank, we just use life insurance as a holding capital. So a bank's going to pay you zero right now, and even if it's paying you anything, it's trapped, or you're getting taxed on that. Your policies are paying 4 to 6% a year right now, and it's tax free. Plus, you get a death benefit. Plus, you get long-term care. Plus, you get leverage.
That's a huge part that you just said, and not everybody's going to catch that, but that long-term care part is huge.
Yep. And then you get positive arbitrage. So leverage, we all understand leverage, and I think most people don't recognize it, but using somebody else's money to buy something, essentially. So even non-investors, they go out and buy or use a credit card to buy stuff. They go out and use the bank, so they're leveraging the bank's money to buy their house, or leveraging the bank to buy a car, but that is somebody else's banking system. So you're taking all your money and transferring today's value of that money and the future value of that money to other institutions. Whereas essentially with a life insurance policy, you're going to leverage the life insurance company's money. Your money stays in the policy and it just continues to grow. And if you're making payments, you're going to make that payment back to your policy.
And that's the thing that is huge, because you're now, let's back that up a little bit. You are leveraging the life insurance company's money. So if you're thinking about that, you put this money into this policy. So you say you put $100,000 into this policy and you're going to borrow 80,000 of it. Okay, here's a couple things that I think are huge that go into this. You don't have to qualify to borrow that money.
Nope.
All you have to do is make a phone call and make a request. So you borrow that money. I used to have people do this all the time. And it's always funny because I feel like this has been the new wave is the infinite banking. But if you look at all those insurance agents that were in the business 20, 25, 30 years ago, all of their retirement is in infinite banking.
Oh, yeah.
Because I used to have retired agents of the company that I worked with come in and they'd be like, hey, I want a loan for this. And then they'd come back a couple days later and they'd write checks, and they'd just write checks out of their Social Security, like, hey, here you go, here you go, here you go. And they never had to worry about money because they were using this banking system, and they never had to ask anybody. What's the hardest people to get approved is as you get into retirement and you have these other incomes, if you've got different things, like it's hard as heck to get approved for stuff. Maybe you don't hit the income requirements. If you do hit the income requirements, it's kicking something else out, so you have to pay for something else. So there's a lot of huge things that it affects people.
And business owners have a problem because on the tax side, we try to show as little profit as possible.
Yeah.
So it's harder for business owners to get loans. So the other part that really benefits from a life insurance policy is it's called positive arbitrage. So basically that means you're buying something or renting something at one price and selling it for a higher price. So like with IULs especially, if your policy is gaining 5, 6, 7, 8, 9, 10, 15%, but your loan is only sitting at 4 or 5, you're creating value and creating money simply for keeping your money inside of that policy instead of keeping it inside of a bank. And the other,
correct, because the other one you're paying interest, and this one you're still gaining interest.
Correct. And then even on whole life, you're always going to get positive arbitrage as well, because you're borrowing at simple interest, and your growth inside the policy is compounding,
which is interesting. But yes. And because we used to talk a lot about the net when I was in that, and I'm going to be honest, I've been out of it for a little bit. So knowing, and I only did whole life and universal life, which was essentially a variation of whole life. But it, like the borrowing the money, there was essentially a net of 2% that you ended up having to pay. So you actually, in the gross scheme, it sounds like it's switched a little bit to where now you're making more interest than you're borrowing interest, or is it? Am I reading that the wrong way?
It just depends on the policy.
Okay.
And it'd really help if I
had an illustration with you. Well, and
but you know,
it is what it is. Everybody's is going to be different.
I've got a lot of videos that I'm putting up, and I'm showing this. But one of my examples is you got an option to either take cash out of your bank account and pay for a car, or borrow money from the bank. And in my illustration, it's showing that the growth is 4% and the bank is 6%.
Correct.
But it actually makes more sense to borrow at the 6%. Because the money inside of the bank account, or in this, or the policy, is continuing to compound. So you actually earn money. I think it came out to you earn about $5,000 or $6,000 on that money staying inside the policy, compared to leaving your money or borrowing from the bank. So you actually made a profit.
Yeah, which is huge. And the numbers thing is it's hard to understand those numbers. Life insurance in general is hard if people are just looking at illustrations. But the thing is, you got to find people that you can trust. Mm-hmm. Like, and trust. That's what, if you're looking for an advisor on anything, you got to know them, you got to like them, and you got to trust them. And that's what I'm trying to do with this channel, is make sure that as many people can find the different people that they connect to. They understand how they kind of talk, and they grow to like them, because they're going to be able to help. And I always bring on people that I know can help somebody, which when you're talking about real estate investing, I think it is instrumental to have some kind of your own banking system to where you can borrow that money from it and still gain money on it. If something happens to you, that money, here's the thing is if they're doing investing and they've got the capital, if let's say something happens to them and they pass away and now that money that's tied up in that house goes to, or that LLC, now they've got a loan on it. Now it has to be sold and now they got to pay off the loan. And there's so many things, or that loan forces them to sell something that they didn't want to sell, where if you have this type of system, now they're getting the cash benefit from the life insurance policy. And you're also getting that house and you don't have that loan on it. So it's different.
In one of my videos, I'm showing, you have a choice, take money from a policy versus paying cash.
Correct.
And what I'm showing is because of the compounding growth inside of the policy, you pay cash, you wipe out that compounding growth curve. So that's got to start all over. And after, I think it was 30 years on this, the value of using the policy plus the appreciation of the house was 3 times. You end up with 3 times as much wealth as you did just paying cash for that house.
Which is huge.
And that's with one house.
Correct. Imagine if you're an investor and you're doing
20, 30, 20. 40.
Yeah.
I mean, I think it ended up something like the total value over here was, and I just used a $100,000 house. I know we can't get that anymore, but the total value over here with appreciation and putting the money back in was something like $300,000 or $400,000, and over here is about $1 million.
Correct. And that's something that if people are looking at buying investments, I know that's one big thing is, I got to pay in cash because I want to be able to afford it and I want to cash flow. This is how you cash flow. Put your money in this vehicle, use the money from this vehicle, pull it out, borrow it, use it to pay cash for that, and use the money off of that to just pay yourself back. And you're going to continue to grow money just like you're talking about.
And the great thing about the loans is when you borrow money from the bank, they dictate when you pay that back. With the policies, you dictate. You don't ever have to pay it back technically, because now I don't recommend that. I always recommend paying it back.
Correct, but you have the flexibility of having a bad couple of months.
And that growth inside of the policy is going to outpace the cost of the interest rate. Or interest cost.
Yeah, and you're not getting slapped with late fees. I've always thought that was
appraisal fees.
I've always thought that was the craziest thing. Hey, you can't pay for this. So what we're going to do is we're going to add another $50 to $100 on top of this so that you still can't pay for it.
Yeah.
Which I understand if you didn't charge late fees, everybody would be late kind of thing. But here's the thing. When I was with the insurance company that I was with, they didn't charge any late fees. I assume we had one of the best rate with people not canceling because of non-payment, because if they were late, we just took the payments 3 days afterwards. They had like a 15 to 30 day grace period anyways. So just take the payment.
And another thing is, so, I typically advise paying that interest cost up front, but the dividend side and paying back the policy, the loan.
Correct.
But that policy is creating a dividend. So you can actually use that dividend to pay back that loan if you want.
Which is huge. And it gives you the flexibility. And that's where you were talking about earlier, which I kind of backed you up. But that dividend and the interest that you're making off of that. So you said eventually you want to buy another policy.
Yep.
You're using that interest and that dividend to pay for that other policy.
There's a couple different ways we'll do it. A lot of times it depends on the client, but several of my clients have come to me and they're not real sure. So I don't max them out. Like, I think they should go with this size of policy, but we end up going with a smaller size just until they're more comfortable with it. And then what happens with every single one of my clients is they end up getting another policy within 2 years.
I think that's great because you're keeping them from payment shock. which is something that if you throw it all at them at once.
Yep.
And I think it's good to illustrate. You have to be able to illustrate that as this is a financial vehicle for you
Correct.
to use. Because if you're not, and you're just selling it as a policy, that is a lot of money to pay for a life insurance policy.
Yeah.
If that's all you're using it for.
And one of the things we talk about is financial vehicles. So we get caught up in 401ks, IRS, this and that, IRAs.
Correct.
We don't realize
The IRS will take your money.
Well, not if it's in an HSA, Roth, or a life insurance policy.
Yeah.
But we get trapped inside what these things are called, and nobody really notices what they actually do to your money. So one of the things that I just got done creating a video about this, the best financial vehicle for access to capital.
Okay.
So we've got bank accounts, we got lines of credit, we got your retirement plan, and then we have life insurance. So those are the only 4 financial vehicles that actually provide access to capital. And so what I did is I go through all the pros and cons in all of them.
So let's do that real quick. Because here's the other thing. Where can they go to find these videos?
They are on my Facebook wall.
Okay. What's your Facebook?
Andrew Keene.
Andrew Keene. So look him up. You're going to find him because you see his face on it. It's Blackstone Wealth Protectors, who he works with. But I'd look him up and watch the videos. But let's go through those real quick and name me. So what were the 4 again?
Bank accounts,
line
of credits, and
line
that
of
can
credits.
be
like home equity, line
that
of
can be
credits,
any line of credit,
etc. Okay.
And then retirement accounts, and then life insurance.
Okay. So let's go back to bank accounts. So that's an asset vehicle. What is one pro and one con of that?
Pro is you can go down to your bank down the street. You have access to it. It's a ATM.
Correct. So I've heard something that is that I think is more interesting that I think people need to know, because I listen to a lot of podcasts. We were talking about
a lot of them are cutting off access to cash.
That's the thing, and is you're putting all this money in there, and then go into your bank and ask them for that 10 grand that you need, that 20 grand that you need, that 100 grand that you need, because you're going to go pay it to somebody else. Go ask them for it.
Yep.
See if they'll give it to you.
So interesting. So during the Depression, actually, banks all ran out of money.
Mm-hmm.
You know where all the money came from? Life insurance companies.
Yeah, because they have all the money. Go look up the top 100 on the Forbes 500 list or whatever. There's a lot of life insurance companies up there.
The 5 biggest banks have over $75 billion in life insurance assets.
That's a lot. Okay, so bank accounts, a pro, you can go get your money. Wink, wink. What's a con? What's of using your money there?
No value. You're losing value.
Correct, because it's not keeping up with inflation. It's not gaining anything.
It's not protected. So if you get sued, that money's gone.
Correct. Yeah. You make sure you have correct liability limits. If you don't have correct liability limits or you don't know, find your insurance guy and make him explain them to you. But
yeah, you need at least $250.
At least $250. And I'll tell you what, on a $1 million umbrella costs you about $10 a year, $15, maybe $25 if you are $25 a month. I mean, $10, $15, or $25 a month. If you're a terrible driver, it could be somewhere around $25 a month, and that's $1 million.
And if you got a business, that umbrella may not cover your business.
It's another huge thing. People that are working from home and using their business or using their vehicles as business vehicles or using their home. It's one of those things where a lot of people want to hide that from their insurance agents. If they're talking to them, they're like, I don't want to tell them that I have a business. Okay, that's awesome. Till you invite a client into your house, they get hurt and they sue you, and now it's not protected because they were there on business. Yeah, that becomes an issue. So make sure I always tell people you can be open and honest with your insurance guy. Whether he chooses to be open and honest with the company, that's on him. Like you be open with that's why I always tell people, be open and honest with me, because I'm going to do what I can to protect you. I'm going to tell you what are your potential risks.
And let's be real. You're going to pay an extra $20 a month for that, $10, something like that.
Mm-hmm.
The agent's not making any money off of that. He might make $1, $2.
No.
He's not selling it just
to
make $1.
Correct. Yeah. No, the percentages are way too low. We're doing that to help you. Insurance agents are doing that to help you. I'm not an insurance agent anymore, but it was a lot of fun when I was. So the second one,
lines of credit.
Lines of credit. So what's a pro having a line of credit?
So you do have access, man. You do have creditor protection. So if you get sued, they aren't going to force you to use that. You don't own that money, so you can't.
Correct. It's not technically yours.
Away.
But then again, it could be taken away at any point in time.
Correct. Some of the pros on it is if you use it correctly. I don't want to say correctly, but if they're making money off of you, you're probably going to get an increase of your line of credit. Correct. And the con is you're paying a lot of money compounding interest, especially if it's credit cards, 20-30%. And I see these financial advisors. Oh, this burns me. They're putting your money inside of the market to watch it go up and down, and let's just pretend for a minute it never loses value. You get 8% a year, 10%, whatever, but you're paying 20% credit card interest. A lot. You're losing.
Correct.
You need to pay off that debt.
Correct. The best ones that use it is they use it, and as again, a lot of these things are financial vehicles. You should use them, but you need to use them with a plan, because like if you're going to use the credit cards, then that is a place where one, I think something that's huge for credit cards is the trackability. I think the trackability is huge. And like being able to use it and pay it off and use it and pay it off. Like I was talking to somebody the other day, they said they paid off their credit cards twice a month, which is like, that's smart. Like use it, pay it off. One, it gives you a vehicle that you can track it. And if you have different businesses and you have different stuff, you use different credit cards for different stuff.
Absolutely.
Because it just makes it easier come tax time.
That's one of the things that I teach about on the tax side. So the number one tax strategy for any business owner is good bookkeeping. If you don't have good bookkeeping, we can't help you.
It's hard. Mm-hmm. It is impossible for somebody to help you if they can't get a clear picture.
And if you get audited, the agent's going to say, well, we don't know what to make of this. We can't figure this out. And they're going to tax you how they want to tax you.
Yeah. Here's his gross income.
Yep. He can't prove this, and this. We're not. Yeah. You're paying taxes on that entire gross income. I actually had a phone call a couple weeks ago about someone, and they had a $60,000 tax bill, and they didn't have good books. And actually, I just got one over this weekend. It was $60,000, I think, for 2018, $140,000 for 2019, and that means they're going to get audited for 20 and 21 as well. And they don't have good books. That they can't even find half of their stuff from 2018, 2019.
And it's going to be hard.
Correct. And they're going to end up probably with a $300,000 to $400,000
tax
bill at the end of the day.
Oh my gosh. And that's a nightmare. It doesn't matter what kind of money you're making. That's a nightmare.
Oh yeah.
Yeah, no, so that lines of credit, the pros, it helps with bookkeeping. And it gives you access to some cash that not necessarily yours. Cons are you're paying a lot of interest on it. Okay. The next one was
retirement accounts.
Okay.
So you can only get up to 50%, up to $50,000.
So this is the con.
Yep.
Oh my gosh.
So your money's trapped, but guess who's using it?
The government.
Wall Street's using it.
Oh, Wall Street, I guess.
And actually, if it's in an IRA or 401k, the government's going to make more money off of it than you ever will.
Man, that's.
I got a video that I'm working on showing all that as well.
That's disappointing. Okay, so they're using a lot of it. What is the pro of having those retirement accounts? If you don't have anything and you at least have those, that's the pro. In my opinion, that's the pro.
So we'll say the pro. We'll start out with the Roths. Of course, tax-free growth.
Correct.
HSAs, you're deferring your taxes, tax-free growth, and you take it out tax-free. So HSAs.
Okay, but there's some limits on that too, of how much you can put in and et cetera, right?
Yeah, there's some limits on that. But what most people don't know is you can actually use a self-directed HSA similar to how you can use a self-directed Roth. So one of the tax attorneys I work with, probably the craziest investment I've ever heard. Basically, his HSA owns a company. They've hired a kid down in, I think, the Philippines. He plays video games. He racks up points for this video game. Well, he racked up enough points to buy a starship. Well, the HSA sold the starship for $100,000 cash. Right? That's what I thought.
That's interesting. Okay.
But
we'll take that nugget and just put that over here. But
there is always a way to make money.
There's always a way to make money.
Now, with the traditional plans, you're deferring your taxes and you're building up a tax liability for retirement. So we've been sold on the idea to defer all your taxes. Well, currently, we're in one of the lowest tax brackets in history. Where do you think taxes are going to go?
Up.
So we have all these people deferring taxes at a low rate, and they're going to pay higher taxes on them in the future. Mm-hmm. So since I've been in taxes, one of the biggest complaints I've got for retirees is they're actually paying more taxes in retirement than they did while they were working.
Yeah, because now they have them, especially if they did it well and they saved well and they have a decent amount of income coming in.
And we have no idea. So if we go back to the, right now, 25 to 35% of your 401k IRA is an IOU to the IRS. So if we go back to, it used to be 50, 60, 70%, even upwards closer to 90. So all this money strapped in a retirement account, the government's getting it. And there is nothing you can do about it.
Yeah.
So I am not a fan of those accounts in any form or fashion.
Okay, fair enough. So then we get to the bottom, the infinite banking, the life insurance. What are the pros? What are the cons?
We'll start out with the cons because there's really not that much. So the cons is building your policy up. They make a big deal about, or let's say like with a bank account, you got 10 grand, you have access to all 10 grand.
Correct.
Whereas with the bank account or with the policy, you're only going to have access to about 70% of that from day one.
Correct.
And then over time, we have what's called a break-even point. So, and we typically make that 5 to 7 years. So let's say after 5 years, you put 50 grand in. Well, now
you've got 50 grand.
You got 50 grand in. And then the next year you put in 10, your policy is going to grow by 11 or 12. And the next year you put another 10 in, it's going to grow by another 12 or 13. And then you put another 10 grand in, it's going to grow by 13 or 14.
It's continuing to grow.
Correct.
But it takes time. And that's the other thing that I think, like, we talk about financial vehicles and using these other things and using this instead of loans. But the thing is, with this stuff, you still have to have the money.
So that's a big con. The pros,
depending on how you look at it. Yeah, it's
correct. So the pros, you've got the death benefit, long-term care, critical care. So let's just say you get cancer, stroke, or heart attack. They're going to give you a big chunk of change.
Yeah.
Otherwise, where are you going to get that money from? You're going to tell your 401k provider, hey, I've only put in 30 grand, but I need 100 grand.
Can I get an advance on my retirement account?
But you've only put in 30 grand. Well, you can have the 30 grand, and by the way, you're going to...
Well, and I think that's something that we need to hit on a little bit. What you're talking about is you're talking about this critical care and this long-term care and the amount of money they put in. The thing is, with that stuff, the long-term care, the critical care, they can advance their death benefit. That's why I said it the way I did with, can I get an advance on my retirement account? Because they can get an advance on, I'd say it's an advance, but you can activate that life insurance policy to pay out for your life, your long-term care, your critical care, etc.
Correct. And then when we talk about access to capital, so, you've got your cash inside your bank.
Mm-hmm.
Okay. You're going to save, spend it, gone. Save, you spend it, gone. So every time you spend it, you start the compounding growth all over. Whereas in the policy, you never, ever stop that compounding growth curve.
Yeah. And you're paying it back, but you're still gaining money on all that.
Correct. And then we've got, so none of those financial vehicles actually provide a return. Now, the investments inside of a retirement plan are going to provide you a return or a loss. But life insurance, the financial vehicle itself, actually provides you a return.
Yeah.
Of typically right now 3 to 6%.
Well, and here was something I heard the other day, and I think this could be a huge thing for you to be able to use with people, is a guy was talking about the infinite banking. Another guy asked him, if you don't watch Dropping Bombs podcast, you should, because that's where I got this from. But he asked him, he said, I can make more than the interest that you can make off my $100,000 if I want to. He's like, I don't, why would I use you to, I can make 20, 30%, I can turn $100,000 into and gain 20, 30, 100 times my money by buying a business and doing that. And something the guy said back to him was like, okay, cool. Give me that 100,000, then go use your 100,000. And then when you do sell that business, just put the money back in the account and you've gained interest the whole time. That's, if you're a business owner out there and you're thinking about why the hell would I use this? I could just use that capital. You can still use the capital.
Yep.
You may not have access to all of it, but if you're using all of your capital, you're not going to be in business very long. Is what it is. If you're using all your capital, then something's going to come up and you're going to be out of business.
Yeah.
And so why not put it into this financial vehicle that's going to gain you interest? Then you get to take that money back out, reinvest it in whatever businesses you're doing to make money. And then when you sell that business or you get a profit, you just pay it back to the policy, which you own. So it's still your money. And then you can go do it again. If you can repeat that process, that's how you get wealthy.
Yep.
That's how you create generational wealth. I think that is huge. And I really encourage anybody looking into infinite banking to reach out to Andrew. He's going to be able to help you out. So how do they get a hold of your infinite banking book, the one,
Function Like a Bank.
Function Like a Bank, Profit Like a Bank. How do they get a hold of it? Is it out yet?
It's not. I'm hoping probably the next 6 weeks.
Okay. Awesome. So you're talking sometime into September, early October, 2023, they should be able to find Function Like a Bank, Profit Like a Bank.
Yeah, and I go into it. So, we're taught that you put money inside a retirement account and you watch it go up and down and you're going to create wealth.
Mm-hmm.
Well, that's not how that's not how Wall Street builds wealth. That's not how banks create wealth. Banks create it through positive arbitrage, leverage, cash flow. Cash flow creates wealth.
Correct.
And so we're not saying you use this in lieu of a retirement account. We're saying you use it in lieu of a bank account.
Correct.
Now, I'll say I'm not a fan of 401ks in any form or fashion.
But that's that's your preference and you have your reasons why. But I think that's huge for people to know. Like, you can use this as opposed to funding everything with your cash that you got from the bank. Then now, so let's just use a real estate deal for example. So somebody has, let's say they have $1 million and they're buying this $800,000 property that's going to pay them. It's an investment property. It's got multiple tenants. It's going to cash flow. Okay. They pull out that they're going to do this one of two ways. They're going to get a loan on this, which now you're paying interest on.
To the bank.
To the bank, not to you. Or they're going to use that $800,000 out of their $1 million account, put it back here. Now you have to gain that $800,000. It doesn't matter what you're making. You can be making whatever it is off of this amount. It's going to take you multiple years to gain this money back.
Because that whole $1 million is still growing. And let's just say it's growing at 5%. So that policy is making $50,000 a year plus tax free.
Yeah. Yeah. So you just paid it back off of the interest that this is making just off of.
So one of the things that I talk about, and I should have mentioned this earlier, is the industry kind of talks about policy loans. It's more of a line of credit.
Correct.
Because as you put money back in, you have access to that money again.
Correct.
Whereas a loan is a loan. You don't, if you take out a $100,000 loan and you pay 50 of it back, you don't have access to that 50 you paid back. Whereas with a line of credit and with life insurance, you have access to that 50. So you're recycling money and using it over and over.
And on a smaller scale, I used to have people do this, and which I'm not saying this is the way you want to do this, but I used to have people that had life insurance policies that they had a cash value in. And what they would do is they would come in on, a lot of times it was right before Thanksgiving, and they would say, hey, I need $500 out of my loan, out of my deal. And then they'd go buy all their Christmas presents and put it on essentially use it like a line of credit. And they would go buy all their Christmas presents. And then over the next year, they would give us $25 to $50 a month, because that's how they funded their Christmas every single year, was through same thing, infinite banking.
In the way I do mine, I put about 80 to 90% of the money that comes in into my policy. And then because 80 to 90% of my money is now growing value every single year. And then I'll take that out and disperse it how I need. Part of it will go back to my business, pay my business bills. Part of it will go to my personal account to pay all my other bills. But otherwise, if I didn't do that, I'd lose all the value of all that money.
Oh, yeah. Oh, my gosh. It's huge. There's so many good things, and we could go on for days about the benefits of somebody setting up this account and using it strategically, having somebody in your ear to say, hey, this is how you can get this to work for you, as opposed to letting the banks have all your money. I think it's huge. I think it is a way to easily level yourself up without really having to change anything. So I appreciate you coming on, and I think the viewers, you should have grabbed a ton of information out of this. And I think if you need more information on it, pick up the phone, call Andrew. How do they get a hold of you?
785-430-3717.
Perfect. And what about an email address? So if they have questions, they can just email you.
Andrew@blackstonewealthprotectors.com. And I'll leave with this. There's a lot of people out here doing this.
Mm-hmm.
And a lot of the whole life practitioners will hate on IULs. IULs are a different animal. I use both. They have very different purposes. I don't recommend, and actually the life insurance companies don't recommend using an IUL for infinite banking, at least for the first 5 to 8 years. And what I'm seeing is all these IUL people are saying use it. Well, I'm not going to get into it now, but an IUL is not the best financial vehicle as a banking system. It's got a season for a while. So I typically only use whole life for infinite banking, or if they've got a whole life policy set up, we'll have their second policy maybe be an IUL, and they'll use it down the road.
I think that's huge, is be able to help them figure out the plan and orchestrate the plan. Because if they don't have a plan, then like you're talking about, other people are saying, hey, this is what's right. There's so many voices in this industry.
Yep. And
you have to find the right ones, find people that are going to build plans, and everybody's in a different stage in their life. So figure out what stage you're in, and then figure out how, but everybody can benefit from this. That's whether you're the person that is taking every business that you invest in, you're pulling money out of your infinite banking system to pay for that project and then paying it back, and you're doing that on a million, 7-figure, 8-figure scale, or you're the little old lady that is coming in to buy your Christmas presents, using it. It is going to help you and give you something that you own that you can use to make money off of. It's huge. I appreciate everybody watching. And if this is your first time to the channel and watching our interviews with different people around the Kansas City area, I'm Dylan Fry, the real estate guy. I'm here to be your guy for any real estate needs. Here to help you buy investment properties, buy new homes, buy different things. But the thing about me is I have a ton of connections. And I'm always talking to people, and like bringing Andrew on here, I learned a lot during this podcast. I'm always trying to find different people that I can learn stuff from, as well as add value to my listeners. So if you like this video, hit that like button, hit that subscribe button, and then also hit that little bell so you'll get future notifications of any of these videos that I'm posting out here so that you can get as much knowledge as possible. Andrew, I really appreciate you coming on. I'm sure I'll have you back in here at some point to talk about especially that third book you're working on. I know we're going to have you back in here to talk about that, just because I always think it's intriguing. I think a lot of people are going to grab a lot of value from listening to you talk. Go check out his Facebook page, watch his videos. You're going to learn a lot of stuff. Thank you.
Thank you.